Listen, I want you to picture the scene. At this very moment, somewhere across America, likely in a nondescript strip mall office between a vape shop and a payday loan storefront, an elderly 71-year-old widow is pushing a quitclaim deed across a cheap laminate countertop. What's truly heartbreaking is that she's actually smiling. Her smile comes from following advice given by her brother-in-law Gary, the same Gary who lost $40,000 on a Branson timeshare in 2009, who confidently explained over Thanksgiving dinner that the sophisticated strategy wealthy individuals employ involves selling her home to her daughter for exactly $1 American dollar. She's already paid the $15 county recording fee. Now she's passing her daughter a Bic pen and one crisp dollar bill, signing away the deed to her 4-bedroom colonial in suburban Cleveland, purchased with her late husband Jim in 1985 for $52,000, currently valued at $507,000. In her mind, she's outsmarted the IRS, outmaneuvered the nursing home system, and bypassed probate entirely. She genuinely believes she's executed the financial heist of the century, armed with nothing more than a cheap pen and a single George Washington bill. She hasn't beaten anyone or anything. What she's actually done is walked straight into the most financially devastating trap in the entire United States Internal Revenue Code, pulling her only daughter in right behind her and handing the key directly to the IRS through the mail slot. This isn't estate planning by any reasonable definition. This is a financial crime scene unfolding in slow motion. The most disturbing aspect, the part that should make every retiree grip their armchair, is that this woman will likely pass away 15 years from now, still completely convinced she made the smartest possible decision. She'll go to her grave proud of that $1 transaction. Then approximately 6 months after her funeral, her daughter will open an envelope from the IRS, discovering that her mother's brilliant strategy has actually cost her somewhere between $67,000 and $98,000 in federal capital gains taxation alone. Not counting state taxes, not counting the additional 3.8% net investment income tax surcharge, not counting CPA fees, not counting the therapy bills, because combining grief with a 6-figure tax assessment creates a burden the human nervous system simply wasn't designed to handle. Here's the part that should absolutely terrify you. Not a single dollar of that massive tax bill would have existed if the mother had simply done absolutely nothing. If she had taken Gary's barstool legal advice, set it on fire in the kitchen sink, and left the house to her daughter through a properly drafted will or a correctly funded revocable living trust, the entire tax liability would have completely evaporated, wiped clean by a single provision of the Internal Revenue Code, so quiet, so understated, so beautifully hidden in plain sight that 95% of Americans have never heard its name. Internal Revenue Code Section 1014, the step-up in basis. 5 simple words. One provision that, when used correctly, represents the single most powerful wealth transfer mechanism the middle class has ever been granted by Congress. And simultaneously, the one provision that the moment you sign that quitclaim deed and transfer your house during your lifetime, for $1, for $10, for love and affection, you permanently, irrevocably, with no takebacks and no do-overs, destroy forever. You haven't outsmarted the IRS. You've taxed your own children with your own pen at your own kitchen table while Gary nodded approvingly. This content does not constitute official tax advice. It is a survival guide for an unguarded vault. Consult a qualified real estate attorney and tax professional in your specific state. Now let's proceed with the financial autopsy. To understand why the $1 sale represents a financial crime against your own family, you must grasp a concept the IRS has very deliberately made boring and inaccessible, because a confused taxpayer is invariably a profitable taxpayer. This concept is called cost basis. Write it down. Tattoo it on your forearm if necessary. Cost basis is the single most important number attached to every appreciating asset you will ever own, and 90% of retirees couldn't accurately define it under oath. Cost basis is the IRS's official institutional memory of what you originally paid for the asset. When you purchased your house in 1985 for $52,000, the IRS opened a permanent file. That file says, "Taxpayer paid $52,000 for residential property at this address." They will remember this number indefinitely. On the day the asset is sold, they subtract this number from the sale price. Whatever positive number remains, that's capital gain. And taxing income is precisely what they do. Cost basis isn't static. You can adjust it upward. Every new roof, every kitchen remodel, every HVAC replacement, every deck, every legitimate documented capital improvement adds to your basis and reduces your future tax liability. Standard repairs don't count. Painting doesn't count. Only improvements qualify. Your real basis in 2026, assuming good records, probably isn't $52,000 anymore. It's likely $80,000, $90,000, perhaps $110,000 if you've completed major renovations. Pull together every receipt, every contractor invoice, every Home Depot bill going back decades. The IRS requires you to prove every dollar of basis improvement you claim. If you can't prove it, in their eyes, it never happened. This is where American tax law forks into two completely different universes. Road 1. Transfer the house during your lifetime. It doesn't matter if you sell it for $1, gift it outright, or add your daughter's name to the deed as a joint tenant. The moment you execute a lifetime transfer of an appreciated asset, the IRS applies a rule called carryover basis under IRC Section 1015. Your basis automatically becomes her basis. That $52,000 number from 1985 packs its bags and permanently moves into your daughter's tax return. She has inherited not just the physical house, but the IRS's 40-year institutional memory of what you originally paid for it. Road 2. Do absolutely nothing. Keep the deed in your name. Eventually die in 2041 at 86 with the deed still registered solely in your name and a properly drafted, revocable living trust naming your daughter as beneficiary. The moment your heart stops, IRC Section 1014 fires automatically like an airbag deploying. The IRS's memory of your $52,000 original basis is completely wiped clean. In its place, the IRS writes one new number: the fair market value of the house on the date of your death. If the house is worth $600,000 that day, your daughter's new basis becomes $600,000. If she sells it the following week for $601,000, she pays capital gains tax on exactly $1,000. If she sells it for precisely $600,000 flat, she pays absolutely zero. The entire 40-year appreciation cycle, that $500,000 of equity built across a lifetime of working double shifts, refinancing twice, and skipping family vacations, passes to your daughter completely, totally, magnificently tax-free. Same house, same daughter, same sale in the same week. Two completely different tax bills separated by tens of thousands of dollars, decided entirely by whether you signed one piece of paper before you died or after. This is the literal mechanical operation of the United States Tax Code as written by Congress and enforced by the IRS in 2026. Now the live mathematics, because you need to feel this in your bones, not just understand it intellectually. You bought the house in 1985 for $52,000. You invested $50,000 in documented capital improvements. A new roof in 1998, kitchen remodel in 2007, master bathroom renovation in 2015, new HVAC in 2020. Your adjusted cost basis is $102,000. Fair market value in April 2026, $500,000. You sell the house to your daughter for $1. The IRS doesn't care. The IRS uses fair market value for all tax purposes. The moment you transfer that house for less than its true value, the IRS treats the difference as a taxable gift. With the 2026 annual gift tax exclusion at $19,000 per recipient, you've just made a gift of approximately $499,999. You must file IRS Form 709 by April 15th of next year. You likely won't owe actual gift tax immediately given the lifetime exemption over $13 million, but you will permanently reduce your lifetime estate and gift tax exemption by that substantial amount. The gift tax filing is merely the appetizer. The real meal arrives when your daughter sells the house. 5 years later, 2031. Daughter sells for $550,000. Her basis is your basis under IRC Section 1015, $102,000. Her capital gain, $448,000. $448,000 of taxable capital gain on a house she received as a gift from her dying mother. She's a 47-year-old hospital administrator earning $140,000 annually. Blended effective federal rate at 16%, $71,680 in federal capital gains tax. Her income plus the capital gain pushes her over the net investment income tax threshold, an additional 3.8% surcharge, adding $17,024. She lives in Ohio, which taxes capital gains as ordinary income at roughly 3.5%, another $15,680. Total tax bill, $104,384. A house that came to her for $1 just cost her over $100,000. Now the correct scenario. Mom does nothing. Mom dies. The house passes through a properly structured, revocable living trust at a date of death value of $500,000. Daughter's basis under IRC Section 1014, $500,000. 5 years later, daughter sells for $550,000. Capital gain, $50,000. Total tax bill, roughly $9,250. $104,000 versus $9,250. Same house, same daughter, same sale price. The difference of $95,134 is the direct cost of one piece of paper signed at the wrong time. That's a Tesla outright. That's 2 full years of college tuition. That's what you handed to the IRS in exchange for feeling clever at Thanksgiving dinner. The geography makes it worse. Florida has no state income tax, which sounds great, until the Save Our Homes Amendment resets the property tax cap the moment you execute a lifetime transfer. I've seen Florida property tax bills triple in a single year after a deed transfer. California's Proposition 19, effective February 2021, ended the parent-to-child reassessment exclusion in most scenarios. A house bought in 1978 for $60,000 with a $1,200 annual property tax bill can suddenly be reassessed to $1.8 million with an $18,000 annual tax bill. California also taxes capital gains as ordinary income at up to 13.3%. Texas has no state income tax and has codified a transfer on death deed that bypasses probate while preserving the full step-up in basis. Free to file, available at the county clerk's office. And most Texans have never heard of it. Instead, they execute the quitclaim deed, lose the step-up, and cost their children $50,000 to $80,000 because Gary said it was smart. 3 states, 3 different legal mechanisms, one identical mistake repeated generation after generation, while the IRS quietly processes the paperwork. Now the surgery. The correct strategies, ones that simultaneously protect the house from probate, protect it from creditors, protect it from mismanagement after your death, and preserve every penny of the step-up in basis benefit, are not exotic, not esoteric, not prohibitively expensive. They cost between $1,500 and $4,000 with a competent estate planning attorney. Option 1. The Revocable Living Trust. You draft a trust naming yourself as grantor, yourself as initial trustee, and your beneficiary as successor trustee and remainder beneficiary. Then you fund the trust by executing a deed transferring your house from yourself individually to yourself as trustee. This funding step is critical. Most DIY trust attempts fail catastrophically here because people forget to move the assets in. Once the house is inside the trust, you retain complete, undiminished control for life. At your death, the house passes outside of probate directly to your named beneficiary. And because the trust remains revocable, the IRS treats the house as part of your taxable estate at death under IRC Section 2038. meaning it receives the full step-up in basis under IRC Section 1014. Both probate avoidance and the step-up in one instrument. This is the answer for most people. Option 2. The Ladybird Deed. Technically an enhanced life estate deed, available in Florida, Texas, Michigan, Vermont, and a few others. You transfer the property to your beneficiary while retaining a life estate that gives you full unilateral control, including the explicit right to sell, mortgage, or revoke the transfer entirely without the beneficiary's consent. Because you retain that control, the IRS treats the house as remaining in your estate for tax purposes. At your death, the property passes outside of probate with full step-up in basis. If you live in a Ladybird deed state and the home is your primary asset, this is often the cleanest, cheapest, most elegant solution available. Option 3. The Transfer on Death Deed, or TODD. Available in Texas, Ohio, California, Illinois, and many others under the Uniform Real Property Transfer on Death Act. You name a beneficiary. You retain complete lifetime control. At your death, the property passes directly to the beneficiary outside of probate, with full step-up in basis under IRC Section 1014. In many jurisdictions, it's a single recordable form, available directly from the county recorder's website. In some states, the filing fee is under $50. The People's Estate Planning Tool, and most people have no idea it exists. 3 options. All 3 preserve the step-up in basis. All 3 avoid probate completely. All 3 keep you in complete control during your lifetime. None require you to sell your house to your daughter for $1. Here's exactly what to do this week, not next month. This week. 1. Pull out your property deed. Look at whose name is on it. Confirm the legal description matches your actual property. 2. Find your original closing statement, the HUD-1 form for older purchases, or the closing disclosure for more recent ones. This document establishes your original cost basis definitively. If you can't find it, request a copy from the title company, closing attorney, or county recorder's office. 3. List every capital improvement made to the house since purchase. Roofs, HVAC, kitchen remodels, bathroom remodels, additions, decks, anything substantial. Pull every receipt, every contractor invoice, every credit card statement. Total it. Add it to your original basis. This is your real number. 4. Schedule a 1-hour consultation with a board-certified estate planning attorney in your specific state. Not a general practice attorney, a dedicated estate planning specialist. Cost: $200 to $500. Value to your heirs: conservatively, $50,000. 5. Under no circumstances, for any reason, regardless of who is telling you to do it, sign a quitclaim deed transferring your primary residence to your children during your lifetime, without first having that conversation with a qualified estate planning attorney. The barstool legal advice industry in this country is a multi-generational tragedy. It's the primary reason families lose tens of billions in completely unnecessary taxation every year. It's the reason adult children end up resentful and angry at funerals. It's the reason houses get sold under duress to pay tax bills that should never have existed. This persists because actual professional estate planning feels expensive and complicated and morbid. People would rather take Gary's free advice than pay $3,000 to do it correctly. Please pay the $3,000. Your daughter will thank you. Your CPA will thank you. The only entity that won't thank you is the IRS. And the IRS genuinely doesn't need your help increasing their revenue. If this video saved one account, told you something the bank never did, or made you furious enough to finally call an estate planning attorney tomorrow, smash that like button, subscribe, and flip on the notification bell. Don't sign away your legacy for $1. Drop a comment below. Tell me, has anyone, a friend, neighbor, barber, brother-in-law named Gary, someone at the VFW hall, or a podcast personality, ever told you that you should add your kids' names to your deed, sell your house to your kids for $1, or execute a quitclaim deed transfer to protect the house from the government? Tell me your story. Name the relationship, the year it happened, the dollar amount they suggested. The comment section on this video is about to become the largest crowdsourced archive of terrible real estate advice on the English-speaking internet. Every retiree who finds this video searching for answers deserves to scroll through those comments and realize they're not alone. They weren't stupid. They were targeted by a culture of barstool legal experts who genuinely don't know what they don't know. Send this video today, not tomorrow, to one retiree friend or family member who you suspect is considering, has already executed, or has been advised to execute a lifetime transfer of their primary residence. Every single day that passes between the conversation you could have with them and the deed they might sign is another day the mathematics get worse. One conversation today potentially saves a family member $75,000. That's not hyperbole. That's the precise mathematics we just calculated together on screen.